So welcome everybody to this evening's webinar. Screening Strategies Revealed, Algy Hall's 4 Ways to Beat the Market. So first up, just a quick disclaimer. Obviously, investment stocks can go down as well as up. Do your own research, and anything you learn on this webinar shouldn't be considered advice. But Algy, thank you very much for joining us.
Thanks for having me.
As I'm sure many of you on the call do know, Algy spent just over 15 years at the Investors Chronicle in a variety of different roles, but probably most significantly as an associate editor in charge of screening and ideas. In 2021, he won the CFA Financial Journalist of the Year award, and he's currently the investment editor at Citywire Elite Companies. So yes, welcome, Algy. Also, maybe some of you don't know, Algy actually interviewed me for my first ever job after I left university. When I joined the Investors Chronicle, and we worked together for about 5 years on and off. And Algy introduced me to the Zulu Principle. He handed me a copy, told me that I had to read it, and I did. And he was right. I had to read it, and introduced me to the concept.
I wish I didn't say have to. You had to read it. I hope they said I recommend you read it.
But you really should. So, which leads us on to Algy's book, 4 Ways to Beat the Market, a practical guide to stock screening strategies to help you pick winning shares. So, and this feels like a pretty good place to start. So, Algy, tell us about the book. Tell us about the genesis of the book and how screening came into your investment process.
So it's probably quite a good place to start as kind of, the Zulu Principle in some ways, because I was fascinated by those kinds of books when I started kind of learning about investment as a writer, and books which kind of put a by the numbers process into place, so a kind of a recipe that an investor could follow. I was also really taken by Jim Shaughnessy's I'm forgetting the name of that book, What Works on Wall Street. I had to look at my bookshelf to actually get it. But that was a kind of a very rigorous back test of data to come up with metrics which helped pick really great stocks. So I suppose I was always interested in this idea that numbers could really get you a long way to where you wanted to go if you were trying to pick shares. And then it must have been around 12 or 13 years ago. There was a column starting on the Investors Chronicle, which was going to be looking at stock screens, and I think there are about 3 or 4 of us who all kind of asked to start trying to produce screens, and everyone else is like, oh god, I don't want to do that, whereas I was the one chomping at the bits going, well, if you need someone to write it this week. And so that column on the Investors Chronicle kind of quickly became mine, and I spent 10 years writing it. And over that time, I had all these screens, and I built up a track record based on actual real-time, the results that the screens spat out. I kind of, realized a lot of mistakes that I was making trying to construct them, and a lot of the kind of things which were more valuable and less valuable with the screening. And Harriman House kind of approached me about writing about stock screening, and so the book 4 Ways to Beat the Market essentially hones in on essentially the 4 real methods, the 4 main ideas that I found create successful screens.
Yeah, so without wanting to give too much away, because obviously I want people to read the book, what are those 4 successful screens?
Well, I mean, I don't think it's giving much away, because I suppose what was really interesting was when I kind of, took a step back and kind of, looked at, because I had a lot of screens, and I found like most of them coalesced around a few ideas probably. And then what really interested me was actually what I found was essentially what you can learn from empirical studies, that there are essentially, 4 really, sensible methods of trying to, think about stock picking. And they're low volatility, which I marry with dividends as well, which is basically you're looking for conservative companies. I mean, the empirical work doesn't have the narrative, I suppose, is the difference between the way I kind of, come at things and all those kind of grand studies which look at this kind of stuff. Then quality as well. So that's kind of, companies which are highly profitable and consistently highly profitable. Momentum, which is the idea that, when things are going well, they tend to get better more often than not. And finally, value, which is much maligned at the moment. But I'm personally of the view that, there's also, there is evidence for this from the kind of quantitative people, that value kind of, doesn't work a lot of the time now because people simply are looking at it the wrong way. The nature of companies has changed, and accounting standards haven't kept up with the way companies have changed. So often people will be looking at things like PE or price to book, these traditional measures of value, and they no longer capture the value which is in some of the world's most successful companies.
So, I mean, a few things there that would be great to dig into, and I know how you feel about accounting standards, so I'm sure maybe towards the end of the webinar we can come back to accounting standards. But we have had a question which I thought was quite an interesting question, which I think sort of captures kind of your sort of the mindset and how you got to, and this is this came in a couple of days ago, so thank you for sending this in. It says, to my mind, the only result that counts when investing is positive results. Therefore, have your methods been back tested, say over the last 10 years, to work to give positive, significant results beating the market? I have found that one needs a significant edge, system, strategy, call it what you like, in order to be successful and make money as a private investor. But as yet, I have not found it.
Yeah, so I mean, there isn't a back test. There's a real-time test, which the book looks at. I mean, it's unfortunate that I left the Investors Chronicle when I did. I mean, I did. There was 10 years of data under my belt when I left, but I left at the end of 2001. So I did capture one big downward jolt during lockdown in the performance numbers in the book, but I didn't get the bear market afterwards, which I think would have been really interesting to map. But anyway, it does have 10 years of data worth of data in it, and also, as I kind of alluded to before, actually, the strategies that it's looking at, they're backed by all this empirical, research, and which goes back in pre-1900s in the case of momentum, and a very long way for the other quant strategies. But in terms of that really interesting question, or part of that great question, in terms of how do you get an edge? In terms of screening, it's all about understanding what you're trying to do at the outset. So trying to understand a strategy that works really well, and once you've got the mechanics of it, then you're in a place to formalize it in the screen if you want to do that. And I kind of always view trying to create a screen in a similar way to the way I view kind of writing something down on paper, because you have to really think about the inconsistencies that you haven't really realized are there in your thought process, and you have to kind of understand some uncomfortable truths about the investment style you're looking at and things like that. So it's just like a really amazing exercise to do, to try and create a really good screen which kind of logically works. And then of course the great thing is screens produce ideas that you can then research, and they keep you disciplined essentially. So if you've created a screen which is really good and which embodies the strategy that you're trying to follow, which has proved itself to beat the market in the past, then you're going to stay disciplined using a screen, because you're not going to go off piece. Because everyone, what we all want to do when one part of the market is going great guns, is just go and jump on that. Whereas normally, when we most want to do that is when it is the worst timing. We've kind of on our strategy which temporarily isn't working, and we jump onto the hot thing just before that's going to stop working.
Yeah, no, absolutely. I think this is quite an interesting point to talk about psychology, which is also something that behavioral finance is something that I'm pretty sure you introduced me to that as well. I find it so fascinating, the psychological aspect of investment and how data and screening and really disciplined, systematic process can help overcome those behavioral traits that we as humans struggle to overcome. Sorry, I know this is a sort of a question you weren't prepared for, but do you want to talk very briefly about the psychological aspect of?
Oh yeah. Well, I mean, that is the foundation of it all. I mean, I think in terms of writing the book, I was just very keen to really say, you've got the evidence there. You can point to performance, you can point to the mechanics of how a company works and how the numbers it spits out. But really, what you really want to understand is the mechanics of how our own minds work, and all these the four strategies in there. They're psychological reasons for why they work. So if you take something like conservative companies, so these companies which have less volatile share prices and kind of are so boring that they don't spend their money, they just pay it out in dividends instead. I mean, really, these are kind of like loser companies in some ways, because what's the excitement with them? But we're prone to think like that, so we undervalue them. And we're also prone to look at the exciting stuff, the kind of the really high growth stuff, which may be growing in crazy ways, and think wow, that's going off to the races. I could make a fortune on that. And we overpay for it. And you look at the performance of the AIM market over well, I think since it was started up. Which is, in the AIM market is full of story. There's some very good companies there, but it's full of story stocks, and the performance is terrible. And it's just it kind of just illustrates that we get seduced by really great stories, and then we actually the boring stuff, which really creates quite a lot of value just by being sensible, conservatively run companies. We ignore it, and they're bargains to be had there, which if you're disciplined, you can tap into.
Yeah, absolutely. So on to a more practical question. I've read your excellent book, and in the book you mentioned using Stockopedia. Do you create your own screeners or use or adapt the inbuilt screens?
So for me, I just use Excel. So I mean, I guess probably I'm kind of I change my mind quite a lot in terms of what I want to do, and I kind of like get ideas like, can I do something like this? Can I do it like that? And Excel's incredibly flexible. So if you can, I mean, I pull data into Excel, and then do everything like that. But I think the screeners, and Stockopedia's got a brilliant screener. Using screeners, you just have to bear in mind that you've got to work with them. So you have to just make sure, once you understand your ideas and the things which you expect, the kind of stock you're looking for to, the characteristics you expect to display, just work with the screener you've got, if that's what you're doing. And screeners are great because you don't have to put in lots of formulas. You don't have to get a machine that's ready and capable of crunching the data. It's kind of there off the shelf for you to get going with. And you don't have to be my book sets out 4 sets of screening criteria, but one of the points it tries to make is that you don't have to be religious in terms of exactly what you apply when. You just have to understand that it makes sense logically in terms of what you're trying to achieve.
Yeah, no, absolutely. We have actually recreated Algy screens as closely as we can. We don't have all of the exact metrics that Algy uses in his books, but obviously, as he says, there is a bit of flex in there anyway. So yeah, we've recreated them, and we'll make those links available at the end of the webinar, because there are some interesting companies that are coming out of those screens at the moment using our screening tool. So we had another question. We've had a few questions actually, and I can see quite a few coming in now about the current market conditions. And this one came in ahead of the webinar. So this is from Lee Pardo. So thank you for this. It's clear that your strategies have been successful in the past, but how adaptable are they to different market conditions and economic environments? Are there any adjustments or nuances investors should consider during volatile times or changing market dynamics?
Yeah, so I suppose there are two answers to the one question I'd have, and one is that certain strategies work better under certain conditions, and I mean it's not all rules are made to be broken, but generally speaking, quality stocks stand up better when there's a big sell-off. That and then they do they don't do that well when there's a big recovery, but then they start to do well when there's more stable growth. Momentum stocks do very well when it's hot, but when markets are hot, not the weather, but they tend to have these awful reversals. So when you've got very strong sentiment going in one direction, there's a very strong trends in the market. When suddenly those reverse, momentum strategies can have a really terrible time. The strategies looking at low volatility or conservatively run companies, as I like to term it, they tend to be the kind of more of an all-weather type of strategy, in terms of they're meant to limit losses, or they have historically limited losses when the markets got into real trouble, but then they underperform when the market's really hot. And then value strategies are complete rip roarers normally when you have the early recovery stage, because these are the stocks which everyone thinks are essentially going to die, and then you get a recovery, and suddenly the equity is worth something. So that's when they've tended to produce outperformance. So that's one part of the answer, in terms of there are different strategies you can use for different market conditions, but predicting where we are is really very hard.
Yeah.
And the other thing is, with the screens themselves, you do have to adapt criteria depending on where you are in a cycle. So stocks get more expensive at certain times, and there's no point in having a kind of very hard and fast rule on value if you're running a quality screen, for example, when the market started to warm up again, because quality stocks tend to be expensive. So you may get away with that, and I mean, I'm talking from experience here. You can get away from that when a market's just fallen out of bed, but later on, when after a recovery, when things are humming along more smoothly, you're going to have to pay up for quality. And the strategy still produces good returns, but it, as we saw recently, if you overpay for quality, that can kind of end badly. As happened kind of during lockdown, I think.
Yeah, no, absolutely. So yeah, a few things in there as well. So the first thing, really, I guess, that timing point. Obviously, the timing point is impossible to answer confidently. But is there a way? Have you got a way of managing the timing issues around shifting your screens, shifting your strategies as the market moves through a cycle?
No, definitely not. I would not dare. I did actually once try and recreate. I forgot. There's a screen which kind of tries to time the cycle and predicted the 87 crash, and I tried to recreate it, and I got a false positive from it, and it's like terrible. It made me give up any any thought of market timing strategies. And I mean, I've never really been a big believer that it is possible to time the market. I think what's more important is to know what you're doing and why you're doing it, and expect underperformance in certain parts of the market. Because I think for most people, the trick is just to persist with a certain approach, and not be scared off, or given to or find it too tedious when when it's not all exciting, and when everyone else is talking about their red hot crypto, or whatever it is. You've got you've got to understand and appreciate what what you're. Oh, sorry, my goodness, this is. I'm very sorry. I thought I'd turned my phone off. That's
No
very
problem.
embarrassing. Yeah. So anyway, yeah. I think the most important, know what you're doing, know why you're doing it, have faith in it, and persist with it. Because because every strategy goes through periods of underperformance.
So at a time like now, obviously it's a struggle for investors, and there's a lot of what should we be doing, especially in the small cap space. I mean, it's been such a terrible time. How are you looking at the market at the moment?
Well, I mean, I suppose it kind of all depends on where you are. I mean, because I write a lot about international companies. I can't, I see quite a lot of stocks which are doing quite well. So, and I know the UK's having a tougher time, but I kind of think when times are hard, I always think this is kind of like you paying the price for being in the market. This is why it's possible to do well from investing, because it's not very comfortable a lot of the time. So it's if you want to have an investment which which doesn't cause these moments of huge anxiety, then it's cash in the bank, and compounding about the actual interest you're paid. But yeah, so I mean I think maybe what people are doing may not feel like it works anymore, and then the question is is that because actually there was a weakness in what I was doing, or is it just because the market is like really actually pretty horrible at the moment? And can I should I just carry on, and or should I change things? And there are always things to change, but yeah.
But having the confidence, either having the confidence in your strategy, or having the confidence in changing it up if needs be, I guess is the way of approaching torrid times.
Yeah, no, yeah, and then like it's just knowing what you're doing. I suppose that's what it comes down to.
So I guess this next question is part of the knowing what you're doing thing, and that is, do you rely totally on your screening strategy, or do you require additional information before you invest?
Well, I mean, I should probably say, because the way the question's phrased, as most journalists are, throughout the country, I'm not allowed to invest in anything I write about. I'd have the cuffs put on me. So I don't invest myself, and financial journalists don't in general. They don't buy the shares they write about. And for anyone who thinks, oh my goodness, this is like I want the money where the mouth is. People have their money where their mouth is. You really shouldn't. It's like the biggest bias comes from owning a stock. So it's quite frustrating as a journalist quite often, but it's also actually really good for your reader that you don't actually invest in in the shares you're writing about, because you can't give an independent view if you do invest. But in terms of the role screens play in investing, sorry, that was a massive detour. Yeah, no, you have to. I mean, screens are great at giving you an idea. I mean, if some products package up, what could be interpreted as screens. You can have ETFs, which use factors and things like that, and you can put your weight behind that. But if you're actually buying individual shares, in order to really be able to ride through tough times and to know when to sell, you have to know what you own, because otherwise you're just lost at sea essentially. And and shares are volatile, and there are always going to be times when you're tested as an investor. And if you're tested and you don't know a thing about what you're holding, then you're going to make the wrong decision almost inevitably, because going back to the behavioral psychology we were talking about before, we're pre-programmed to do the wrong thing at stressful times when it comes to investing. Fortunately, that programming is very useful in other areas of our lives, but when it comes to investing, it's you really have to be sure of why you're in a stock.
No, absolutely. So screens can provide a good starting point. They can sometimes. There are strategies that rely wholly on screening, but I guess as well also just for the fun of investing, it's fun to find out more about the companies as well. That question was from John Reed. Thank you very much for that question. It was actually a two-part question, and the second part was, does your screening strategy take you out of investments as well? We've had a few questions on this sort of theme, so yeah.
No, no, it doesn't. In terms of the data in the book, there's an assumption that every year there's a full turnover of the portfolio based on the new screen, and that's how I kind of just analyze the data. But the stock that you really want is the one that you can buy and hold forever and is going to make you fantastically rich. So really, I'm going to repeat myself totally, which is to say, the best selling strategy that I know of is based on knowing what you're holding, because and really there are ways to become far more efficient at it, which is to essentially diarize what you're doing. You write out what your what your objectives are, why you're buying, what you think is going to happen, and then you keep on updating. And if you look back at what you originally were going into a stock for, and what you're seeing now is nothing like it, and it's not good, then it's probably time to sell. It comes down to just knowing what your objective is.
Yeah, absolutely. And I guess that kind of relates to timing as well, doesn't it? So if you knew up front what your objective was, and the objective was to the growth of the stock over a certain period of time, and that growth has happened and you've achieved what you wanted to achieve, then it might be the time to sell.
Behavioral psychologists who kind of look into this, always, it's that idea of, as you say, Megan, putting a number on it is meant, is kind of considered one of the, very best, ways to do things, because numbers are far less malleable than, the little, lines sentences we write ourselves. So we're very good at convincing ourselves that, what we wrote, whenever it was we actually meant something different to what it did.
Yeah,
but we're even worse at telling ourselves we thought something different in the past than we actually did, which is what I write you down as.
Yeah, one of the problems of being a financial journalist is it is all documented publicly for everybody to see when.
It's kind of it's great though. It's glorious. It's like you can't hide.
I've gone back over a few of my articles and I thought, oof, that was some serious psychology speaking there, in my absolute conviction that this was definitely going to happen. Like the time I was convinced Entertainment One was going to be taken over, and it was eventually, but it was I was so convinced for such a long time. So moving on to a few specifics, had a couple of questions about like the specifics of screening. So this one, which is quite interesting, is longer term rising earnings per share should drive up a share price. Is there any other measure a key factor for growth?
Yeah, no, I thought this was a really interesting question because it's one of the ones you showed me before the webinar, and yes is the answer. And there's one vital factor which I think is really often and easily overlooked, which is that often growth destroys value for shareholders, and it's kind of, it's one of those things which your growth and income are two things which we think they sound so good. what could be wrong? But yeah, so growth destroys value, and then when you say it, it's so obvious. If the return you get on the investment you make to make in order to generate the growth, if that return is lower than the cost of the investment, so if you put it in the awful jargon of finance, it's if your return on invested capital is below your weighted average cost of capital. And there's lots of kind of theoretical ways of calculating the cost of capital and stuff like that, but essentially growth not only is not always a good thing, but is very often not a good thing. So companies will spend money and have a great story and tell you how profitable they're going to be, but actually the reality is often that they're never going to make very much money on all that expensive growth they're piling up. And often they can convince the market for quite a while. They can convince the market for quite a while that they are going to be the next big thing in terms of profits. And then it slowly dawns on everyone that actually, and it's normally after some kind of profit warning or a write down or something like that, it slowly dawns on everyone that this isn't going to happen. And then the share price absolutely tanks because it goes from a rating you'd associate with a fast growing quality stock to a rating you would associate with a company which is going to get out of business if it carries on the way it is going. So it's like, yeah, growth is like can be really quite treacherous actually for investors. So is there any other measure which is a key factor for growth? And yes, it's some kind of quality measure. So return on equity, return on capital employed, operating margins, something like that. You just need to know that it's profitable, or at very least forecast to be profitable at some point, probably. I mean, there are also issues with the fact that very high growth companies don't always fit that mold, because the way investment works, and especially the way investment is accounted for when it's not tangible, means that they can look very unprofitable when actually they're very viable businesses. So
it's the second time you've sneaked accounting standards into
well, yeah.
But yeah, I mean, it's such an interesting question. That, so you mentioned there the return on invested capital versus the weighted average cost of capital. Obviously, yes, that is calculating that is helps to identify these stocks which are overpaying for growth, but it's quite a tricky thing to do, especially as the weighted average cost of capital is quite a complex sum. Have you got a simple way of trying to identify those companies that are overpaying for growth?
I mean, I think rule of thumb is like, if you're looking at operating margins kind of 15% and over, and I kind of use for return on equity 12.5 and over normally and consistently, and then any kind, if you're using return on equity, you also have to check they're not getting a very high return on equity by taking on a lot of debt. So normally I'd test for some kind of debt as well. I mean, you can do, I mean, if for these unprofitable companies, which could be great in a really early stage in their life, you can break the companies down into the individual units of production and see if those are profitable as well. which kind of actually that kind of, you wouldn't be able to do that with the screen. But if you want to kind of go fishing for stocks, which, growing explosively, and, then check whether what management is saying is valid. Generally, what people think is the best way to do it is you go down and look at the individual units, and see if they're profitable and how profitable they are. So it could be a shop for a retailer, for example, but it could be for a kind of software business. It could be a customer. How much does it cost to acquire that customer, and what's going to be the value of that customer over their expected time with that software company. So yeah, I mean there are ways to get around it, but the rule of thumb is always quite neat for screening.
Yeah. So this next question also quite a specific one. Approximately 85% of corporate debt has been termed when interest rates were at record lows. That's according to BlackRock. Any advice? Do you have any advice for identifying the 15% of companies whose corporate debt is turning in a higher interest rate environment that could result in negative cash flow, leading to some short selling candidates?
Yeah, no, I think with this, you actually, it's a case of going into the accounts. I don't know of a screener which will allow anyone to do this, but it's to do with debt maturity, and what's coming due when. You can also look for weak cash flows for companies which are highly indebted, and see if those have maturities coming up. But I think the answer to this one is just get into the notes of the accounts and find out, because I mean annual reports, they've got so much great information in them that you can you can create that advantage for yourself by doing that legwork. But it does, investing is all legwork. You've got to love it, or you're on a hiding to nothing. So yeah.
I guess that comes back to the question that we sort of looked at earlier about the further research, like from your screen helping to narrow down the investment universe, and then once you've got your long list of candidates, spending the time to go a bit deeper and have a look for any that might be problematic.
Yeah, no, absolutely. I mean, it does take a lot of work to really invest properly. So, I mean, the real value of a screen is that rather than having, umpteenth number of, companies that you could look at, and you're not quite sure why you're looking at any of them, you've come back, heard from someone something, or, seen on Twitter this, or, read on Facebook that, you're actually using the numbers to kind of get a really, a tight list. And then, maybe, you can quite quickly get down to, one or two companies on it, which, really worth your while.
Mm-hmm.
Because you also, you can spend a lot of time deciding that a company, or its shares just aren't that interesting. So you really want to be as efficient as possible.
Mm-hmm. Yeah, absolutely. So thank you to everyone who sent in the questions ahead of the session. We've had loads that have come in since we've been talking, and keep sending them in because there's some great ones. This one has leapt out at me. Should we try to beat the market? John Bogle thinks not, and that for most investors tracking fund is the best option. So yeah, should we try and beat the market?
I advise a lot of people not to try. So because if you're really interested in investing, and you want to do the work, then yes. But for most people, this stuff's boring. So when I get my my siblings, when they ask me what they should do, how they should invest, I just say buy the market return. You can buy it for hardly any cost, and you can just let it compound. And for most people who are working all their lives and saving, that's going to be great, and you don't have all this psychological baggage. I mean, you do, you've got the market falling, but as long as you prepare yourself for that in advance, and knowing that the market's going to fall, you're, at some point, and severely, but it almost always historically is carried on, then you actually put yourself in a really strong position. So I've got a lot of time for index funds, and I think for most people they're the best option. I mean, Warren Buffett has said that, and who am I to disagree with him? So, but I do find often these debates are framed in terms of, like, black or white, like it's some kind of binary thing. So it's you have to be an indexer because you can't beat the market. And I just think the intellectual foundation of that, which is essentially the efficient market hypothesis, really, it's just like full of holes. So you can look at like loads of its tenets, and it's just like, well, they're very elegant, but they don't actually, they don't relate to the real world. They don't work. It's like the economics I studied at university. It's kind of like, it's all well and good in these models, but when you actually look at people's behavior, and which behavioral economists have done, then then you can see why none of this actually makes sense. It's life don't work like that. So if you want to, and if you want to do the work, and if you want to educate yourself, because it's about that you do need to understand how the market works and what the psychology of it is and everything, then yes, but once you've educated yourself, you will handle the risk in an appropriate manner for yourself as well. And and like, there are lots of private investors I know who've learned to do it incredibly well, and make a lot of money from doing it. So I think it's totally something to have a go at, if you're if it's something which really, if it's something that appeals to you. But I mean, yeah, but index funds are brilliant, a brilliant vehicle for most people, in my opinion.
Yeah, I completely agree with you. And the question referenced Jack Bogle, who is, I just think, brilliant. Vanguard is a brilliant product. But I also know that the market can be beaten, especially by private investors. There are so many advantages that individuals have over the market. And obviously, with people who are willing to put the time in, able to put the time in, and have that strategy that they have confidence in. But yeah, finding that and finding that you enjoy it is can be very, very profitable. Hopefully at some point. So another question, more about the current conditions. Do you believe we are in an inflationary bear market with a recession pending? Maybe this comes back to the economics. Or do you believe the market has bottomed out and is heading into a new bull cycle? Depending on your belief, does this alter your screening strategies?
I don't know. I don't have any faith in my ability to predict these kind of things. There are obviously a lot of arguments which are very convincing. I'd say, mainly they're on the bear side at the moment, probably is where I feel like, where I'm most convinced. But I know from grim experience that what I, find, intellectually kind of like, compelling is very often like, way off. I mean, if you did have that edge, you would, if you did think it was going to be, there was going to be a big recovery, you would, in terms of, what history tells us, you'd go into value stocks. So stocks which, look completely beaten down. I do think there is a lot of value out there. I mean, that's kind of, being a bit more objective and not trying to predict the future. I look at, some of these UK small caps, which are, very good businesses, but maybe, kind of a bit cyclical, not having the greatest time at the moment. There are worries, obviously, but come good balance sheets, not about to fall apart. And you think, God, these are, very, very cheap. And I think there are quite a lot of companies like that at the moment. So maybe that does suggest that's something to be thinking about. But again, you get lots of companies which are quite cheap when lots of people have lots of things to be worried about. And inflation is coming down, but it could spring back. And I think the market would definitely take fright probably if that happened. And we've got lots of really quite scary geopolitical events happening and threatening to happen. So I think that's something else that we're probably all aware of. But yeah, so if you think it's a recovery, sorry, I'm waffling too much. If you think it's a recovery, you go into value. If you think it's we should be battening down the hatches, it'd be low volatility stocks that these are traditionally, that's the way you'd splice it.
Yeah, and I guess the key there is having the faith to stick with whichever one you choose, because flipping in and out depending on what the market may not be doing, especially with all the geopolitical events on the horizon, is where there's money to be lost, I guess.
Well, for most people, I mean, I'm not saying there aren't any clairvoyants out there, financial clairvoyants. Certainly hear there a lot.
We've had a question that says, what accounting standards do you find problematic?
Oh yeah, okay. So thank you, question.
Yeah, David Thompson. We're very happy about that. It's a very interesting question.
No. I think the main thing. I mean, there are a few, but the main thing that I think private investors have to watch out for is the way intangible assets are accounted for. So intangibles are things like software and brand and all the kind of the investments which you'd associate with the really most the most exciting, most excellent modern companies. So like Nvidia, Eli Lilly, Microsoft, Alphabet, all these, they most of what they invest in, or a lot of what they invest in, is intangibles, and intangibles are not treated as an investment in companies' accounts. So when I, if I was a company and I was investing in a bit of property, I'd be allowed to spread that cost over the property's entire life. But if I invested the same amount in a massive advertising campaign, I would have to take that upfront here and now. And there are some sensible reasons for it, because with an ad campaign, it could launch your brand into the stratosphere, or everyone could think it's absolute rubbish and just never buy whatever it is you're trying to hook. So there's some logic to it, but in terms of the world we live in today, it really distorts the accounts of certain companies, and the most exciting companies. It makes them look a lot less profitable. And then when they do become profitable, it makes them look like they've spent a lot less money than they actually did to get there, because they haven't recorded any of it as assets. So it just makes it very confusing to screen on things like price to book or price to earn.
Ooh. I think it's Algy's problem, not my problem. Looks like that. I'm hoping Lawrence or Sam will tell me if it's my problem. But I assume what is being said. Oh, you're back. Hello? It was. I was just about to pick up the mantle.
Are you trying to send me a message there? Talking about accounting standards.
I saw an opportunity then to start talking about to pick up the conversation and talk about the problems with using price to earnings and price to book, but that was where we got to before your video.
Oh yeah. No, yeah, it's just very hard to make comparisons with price to earnings and price to book, and also some of the classic quality metrics like return on capital employed are affected by it. So it's something that private investors often aren't aware of. they really, you know, should be in terms of, you know, if they're screening, I think. And we all should be. It's very, and you know, you can adjust for it, but it's quite imprecise. It's just very annoying, really.
So obviously, yeah, as you say, you can adjust, but yeah, that's an extra effort. How do you adjust? How when you're building your screens, are you building that problem, the problem with modern companies accounting, into your screens?
Well, I still use things like return on equity and return on capital employed. So, you know, you kind of, because I tend to set bars which aren't too testing, and put emphasis on consistency. I kind of think, you know, it's that seems to work okay still. And then you know, with things like, I mean, you know, price to earnings actually is, you know, I don't think is that great a valuation tool anyway. You know, it's useful, but it's like, you know, you're not going to probably find your great, you know, value stock using it. But I like to use enterprise value to sales a lot, which you know, which is really great, because sales, when a company gets into trouble, sales normally relatively stable, whereas the profitability often falls off a lot. So your price to earning ratios goes sky high. And you know, if you're screening on price to earnings, it'll look like a really expensive stock, whereas in reality, if you look at it against sales, it's like, wow, this is, you know, really interesting. And then if you think the profitability is going to recover, then you've got your recovery play kind of thing. So that's not affected by these issues at all, because sales is before any costs come out. You know, price to book works if you're looking at companies which make money out of their assets, so real estate companies, house builders, you know, finance companies, banks, that kind of thing. So if you know when to, you know, when it's applicable, then you can, you know, then you can use it. And also cash flow is just, you know, if you use and also if you use free cash flow, so free cash flow yield, and you know, free cash flow is the cash flow equivalent of earnings, essentially, or shareholder profit. Often if you use the forecast, the brokers tend to take a lot of the lumps out, because cash flow is quite hard to understand because it can be very lumpy. But brokers tend to smooth it, I find, if you use the consensus forecast. So looking at free cash flow yield, that can be a very useful valuation measure.
And bringing it all the way back round to the Zulu principle, what about the price to earnings to growth ratio?
Yeah, so the price to earnings growth ratio, you know, I think I had a real lesson from Jim Slater himself on screening in general, on investment in general, when I was trying to mimic his screen in the IC, the Zulu principle screen, and I was kind of like rigidly sticking to you know, the peg as, you know, a core criteria that it had to be at a certain level. And he wrote a letter saying, no, you know, when the market gets more expensive, what you have to focus on is quality, and you just have to, you know, be you know, looser with your valuation measure, your peg, which is what I did. And it was amazing. It's kind of like the Zulu screen after I implemented his change, which, you know, I kind of announced to readers with them, you know, slightly with my tail between my leg, but also, you know, very excited. It's kind of, you know, it did amazingly well. But yeah, the peg ratio, I think, really, you know, it's one of those ratios which really has to be married with quality, because I also had screens where which, and this is what taught me a lot about growth investing and how you really need that quality element, where it was really fixated on earnings growth and a peg type ratio, and the performance was all over the place. So they were really horrible things. So I think, yeah, the peg, you know, the peg is ridiculously simple, but can be very useful. But it really needs that quality aspect to sit alongside it, so that you know that, you know, you're more likely to be getting a bargain growth, because the growth is valuable, rather than just being buying into, you know, a company which is like, you know, pushing up earnings in all the wrong ways.
Yeah, no, absolutely. And I I think the PEG ratio can be, like I always remember we kept on trying to find the PEG, a company with a PEG of less than 1. And that was in the just as the bull market was really reaching its peak. And it's rare to find a company with, or it certainly was when we were looking for them, which was a really high quality company with that PEG ratio of less than 1. Finding them is it's quite exciting.
Although always, I think the trouble with valuation is if you find a really something which is really cheap, the first thing you have to look for is the reason why it's so cheap. So I mean, I think any value situation, especially as a writer, and presenting stocks to readers, I always assume it's cheap for a reason, and it normally is. And then the question is the reason good enough? Kind of thing, or are things going to change?
Yeah, and I think that's quite a big psychological hurdle, isn't it, for value investors? It's one that I really struggle to get my head around. The if it's cheap is it cheap for a reason, or is it not cheap? Is there value to be found there? And it's hard, isn't it, to make the decision that actually yes, there is value to be found in some stocks.
Yeah, well, yeah, no, I think the tenet of faith for any value investor is reversion to the mean. So, companies go through hard times and get back to, what they once were, and plenty do, which is the good news for value investors. It can be very unpredictable when they do, and also, yeah, there are those value traps out there who they actually, the mean they're getting back to is actually deteriorated massively due to disruption or something like that.
Absolutely. Well, we've filled the hour with lots of really great questions. Thank you everyone who's asked questions, and thank you Algy for answering all of them. It's been great to have you on the webinar and learn more about your process, your strategy, your way of doing investing, and hopefully everyone's learned something. So thank you all for tuning in, and have a great evening.
Thank you very much. It's an absolute pleasure.
Thanks. Bye.